Welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoen. In today's episode, we will cover the latest updates and trends that are shaping the mortgage and real estate landscape in Ontario and beyond. From currency fluctuations to interest rate expectations and housing affordability, we have a lot to discuss. So let's dive right in. The Canadian dollar saw an uptick against its United States counterpart this past Friday, despite the release of weaker-than-expected Canadian GDP data. This increase was largely due to a drop in United States bond yields, which offset the growing bets that the Bank of Canada might cut interest rates next week. The loonie was 0.3% higher, trading at 1.3640 to the United States dollar, or 73.31 United States cents, after fluctuating within a range of 1.3620 to 1.3689. According to Sean Osborne, chief currency strategist at Scotiabank, the Canadian dollar is holding a minor gain against a somewhat softer United States dollar for the week. Osborne noted that the saving grace for the loonie on Friday was the weaker-than-expected United States personal spending data, which weighed on both United States yields and the greenback. The United States dollar and Treasury yields fell as data showed that United States inflation remained steady in April, while consumer spending weakened. Meanwhile, the Canadian economy expanded at an annualized rate of 1.7% in the first quarter, which was lower than expected. Additionally, the pace of fourth quarter growth was revised down to 0.1% from the initially reported 1.0%. Following the release of the GDP report, the likelihood that the Bank of Canada would lower its benchmark interest rate from the current level of 5% at the policy decision on June 5th, climbed to 80% from 66%, according to swaps market data. Simon Harvey, head of foreign exchange analysis for Monex Europe and Monex Canada, warned that failing to cut rates would risk keeping policy overly restrictive and could necessitate a much more aggressive easing cycle toward the end of the year. Harvey also mentioned that a more dovish outlook for Canadian rates reinforces their bearish stance on the Canadian dollar. Canadian bond yields fell across the curve, with the 10-year yield down 7.1 basis points to 3.631%, extending its decline from a 4-week high of 3.783% reached during Thursday's session. So, what does this mean for the mortgage and real estate market in Ontario? Well, a potential interest rate cut by the Bank of Canada could have significant implications. Lower interest rates generally make borrowing cheaper, which could stimulate housing demand. However, it also means that existing mortgage holders could see their variable rates decrease, providing some relief in monthly payments. That does it for our first segment. Stay tuned as we pivot to discuss the costs associated with a 30-year mortgage. You will not want to miss this, as we delve into how the numbers can be astronomical. Next, we turn our attention to the costs associated with a 30-year mortgage. Many potential homeowners are drawn to the idea of lower monthly payments that a 30-year term can offer. However, the overall cost can be significantly higher compared to shorter-term mortgages, and the difference can be, as some experts describe it, astronomical. When you extend a mortgage over 30 years, you are spreading out the principal and interest payments over a longer period. While this reduces the monthly payment amount, it also means you will be paying interest for a far longer time. This can result in paying tens of thousands, or even hundreds of thousands, more in interest over the life of the loan. For example, let us consider a $500,000 mortgage with an interest rate of 3%. With a 30-year term, the monthly payment would be approximately $2,108. However, over the life of the loan, you would end up paying around $887 in interest alone. In contrast, if you were to opt for a 15-year mortgage at the same interest rate, the monthly payment would be higher, approximately $3,450, but the total interest paid would be significantly lower, around $122,684. The difference is stark. By choosing the 15-year mortgage, you save over $136,000 in interest payments. Of course, the higher monthly payment might not be feasible for everyone, which is why many people opt for the longer term. But it is crucial to understand the long-term financial implications. Another factor to consider is the impact of interest rate changes over time. With a 30-year mortgage, you are more susceptible to fluctuations in interest rates, especially if you have a variable rate mortgage. Even a slight increase in interest rates can have a substantial impact on your overall cost. So, what should potential homeowners do? It is essential to weigh the pros and cons carefully. If you can afford the higher monthly payments of a shorter-term mortgage, it might be worth the significant savings in interest. On the other hand, if cash flow is a concern, a 30-year mortgage might be more manageable, but be prepared for the higher overall cost. In conclusion, while a 30-year mortgage can make homeownership more accessible with lower monthly payments, the long-term costs can be considerably higher. It is a decision that requires careful consideration of your financial situation, future plans, and tolerance for risk. In recent months, there has been a lot of discussion about the role interest rates play in housing affordability in Canada. Since early 2022, rising interest rates have significantly worsened housing affordability, making it increasingly difficult for Canadians to purchase homes. While the Bank of Canada's recent and expected rate cuts might offer some relief, a review from Desjardins Economic Studies concludes that a return to pre-pandemic levels of affordability is unlikely. To recap, housing prices in Canada surged from 2009 to 2017, with a brief moderation in 2018 due to changes in the mortgage stress test. Between April 2020 and February 2022, ultra-low interest rates caused housing prices to skyrocket. When the Bank of Canada rapidly raised interest rates, affordability worsened even further, as higher mortgage payments made already expensive housing even more out of reach. The Desjardins report offers a glimmer of hope for prospective homebuyers, predicting a slight buyer opportunity in late 2024 or early 2025 if interest rates decline as expected. However, this forecast comes with several caveats. The Desjardins Affordability Index, which measures housing affordability across Canada's regional markets, compares the decline in mortgage payments from falling interest rates against the anticipated rise in housing values due to lower rates. Given that any decline in interest rates is expected to be moderate in the short term, mortgage payment relief will likely be minimal and offset by increasing housing values. The report also points out that muted income growth, an often neglected variable in determining affordability, further diminishes the likelihood of significant improvement in housing affordability. The findings may help explain the outward migration from Ontario to the western provinces. Despite recent affordability erosion in Alberta, housing prices in that province remain significantly lower than in other Canadian jurisdictions. Considering that average household incomes are higher in Alberta compared to Ontario, the western migration is understandable. Housing affordability is expected to be a key issue in next year's federal elections. Election years typically bring promises of measures to improve affordability. One such measure that may feature in political manifestos is extending the amortization period, which currently stands at 25 years in Canada. However, Desjardins' analysis warns that extending the amortization period could worsen affordability in the medium term, as rising housing values would negate the immediate benefits of longer amortizations. Housing advocates in Canada have also criticized the rapid increase in international students and non-permanent residents, arguing that this surge has driven up housing demand. In 2022 alone, Canada's population grew by 1 million people, with the current annual growth rate rivaling that of some African countries. The report estimates a planned reduction in non-permanent residents by 25 to 35% by the end of 2026, but found no evidence that this would improve affordability. Interestingly, non-permanent residents are more active in the rental market, with limited impact on the resale market. However, a significant side effect of reduced population growth could be a reduction in housing supply, as some non-permanent resident workers are employed in construction. This lower supply could exacerbate the demand-supply imbalance. The report also simulated the impact of an 80s-style recession on housing affordability. Surprisingly, their conclusions mirrored previous discussions on the unintended consequences of recessions restoring affordability. The report noted that price declines and lower mortgage payments would be accompanied by massive layoffs and income losses. It warned that those hoping for a recession should weigh their home buying ambitions against immense longer-term economic and social costs. If a recession, slowing population growth, or extended amortization periods cannot improve affordability, what can? The answer, according to Desjardins, lies in building more houses, many more. Increasing housing supply is identified as the only sustainable long-term solution. The Canada Mortgage and Housing Corporation estimates that the country needs 5.8 million new homes built within the next decade to restore housing affordability. Canada's policymakers have grappled with housing affordability for a while now, often resorting to perceived quick fixes. However, there are no quick solutions to this issue. The only answer is to increase supply, which requires a concerted effort from both the public and private sectors, and a consensus that building more homes is imperative. This week, we have some concerning news about the Canadian mortgage and employment landscape. According to recent reports, Canada has seen a sharp rise in unemployment rates, particularly among young adults and recent immigrants. This surge can be traced back to the rapid increase in immigration aimed at filling job vacancies in 2022. However, the number of vacant jobs has since declined significantly, while immigration has continued at a similar pace. As a result, both young adults and recent immigrants are now facing unemployment rates double that of the average person. This high unemployment rate is putting downward pressure on wages, which is especially challenging given the soaring cost of living for these groups. In contrast to the gloomy employment picture, Canada's gross domestic product, GDP, is on track to outperform expectations. Despite many predicting the death of the Canadian economy, real GDP is set to beat the central bank's projections. This comes even as inflation has suddenly accelerated, making the likelihood of a second interest rate cut in July very slim. One of the few sectors dragging down the economy is housing. Despite various subsidies and rapid population growth, the housing market continues to slow. This slowdown is largely attributed to state subsidies that are supporting inefficient market operations. On the mortgage front, Fitch Ratings has forecasted a significant rise in Canadian mortgage arrears. The credit rating giant expects the mortgage arrears rate to surge by 50% by the end of 2024. While this spike is anticipated to be relatively short-lived, with rates expected to pull back by the end of 2025, it is unlikely that arrears will return to the near-record lows we are currently experiencing. Turning to population growth, Canada is set to see a dramatic reduction in its growth rate. The National Bank of Canada notes that the growth rate, which reached record levels in recent years, is expected to average just 0.7% over the next 3 years. While this is still nearly double the rate of the Organization for Economic Cooperation and Development average, it is only about a fifth of the rate seen last year. This rapid shift could have significant implications for various sectors of the economy, including housing and employment. In another revealing statistic, a new analysis from CIBC has found that a third of Canadian first-time homebuyers are now relying on six-figure gifts from their parents to purchase a home. This is a significant increase from just a few years ago, when only a fifth of first-time buyers needed such substantial financial help. The size of these gifts has also climbed, now averaging six figures in 2024. This trend is not limited to first-time buyers. Increasingly, families looking to upgrade their homes are also turning to parental assistance. While helping their children is expected, this practice is contributing to increasing wealth disparity between households. Adding to the economic complexities, Canadian inflation has come in higher than expected. The annual growth of Headline Consumer Price Index, CPI, accelerated to 2.9% in April, adding 0.3 percentage points from the previous month. Core CPI, which is preferred by the central bank for its lower volatility, showed a similar trend. With inflation now barely within the Bank of Canada's target range, the likelihood of an interest rate cut in July has diminished, as it could risk reversing the progress made in controlling inflation. Looking ahead, Canada's population is projected to hit 63 million by 2073, according to the latest forecast from Statistics Canada. While this represents substantial growth, it also brings challenges, particularly with an aging population. The forecast indicates that between 21.9% and 32.3% of the population will be 65 or older by 2073, which could lead to significantly higher healthcare and dependency costs. However, The pressure from this demographic shift is expected to be less noticeable after 2030, when the shift towards older households peaks. And finally, in the Greater Toronto Area, new home sales have plummeted by 71% in May, marking the weakest demand ever recorded. Year-to-date sales are now the worst on record, while inventories have reached their highest level in May over the past decade. This trend contrasts sharply with population growth estimates and reflects similar metrics such as rising residential and office vacancies. Our final segment today focuses on property tax rates across Canada in 2024. According to a recent study by Zoocasa, property tax rates have seen significant fluctuations in various Canadian cities. St. John's, Newfoundland, has experienced the highest year-over-year increase in property taxes, with an uptick of 9.64%. This makes it the city with the most substantial tax hike this year. Interestingly, Montreal saw the largest decrease in property taxes, with a reduction of 6.18%. The pause in rate adjustments during the pandemic has led to these substantial increases as cities try to compensate for that period. Following St. John's, Victoria experienced the second highest increase at 870%. Despite this rise, Victoria still maintains some of the lowest property tax rates in the country. London, Ontario has also seen a significant increase in property tax rates, with a 7.66% rise. This positions London as one of the cities with the highest property tax rates in Canada. On the flip side, Montreal's large decrease offers substantial relief to property owners. Regina and St. John, New Brunswick also saw reductions in property taxes by 3.71% and 2.47% respectively. The median year-over-year property tax change for the 24 cities analyzed is 4.88%. In terms of cities with the lowest and highest property taxes, British Columbia stands out for its relatively low rates. Greater Vancouver has the lowest property tax rate in the country at 0.29681%, which translates to $2,968 for a home assessed at $1,000. Abbotsford follows with a rate of 0.39590%, equating to $3,959 in annual taxes for a similarly valued home. Victoria also offers affordable property taxes at 0.47416%, resulting in $4,242 annually for a home assessed at $1,000. Conversely, St. John, New Brunswick, remains one of Canada's most expensive areas for property taxes, even after its 2.47% decrease. Homeowners in St. John pay significant amounts, such as $7,900 for a $500,000 home and $15,800 for a $1,000 home. Sault Ste. Marie, Ontario, has an even higher tax rate of 1.7891%, leading to $8,846 in taxes for a $500,000 home and $17,091 for a $1,000 home. This means that Vancouver homeowners pay less than half in property taxes for a $1,000 home compared to Sault Ste. Marie homeowners for a $500,000 home. In Ontario, property tax rates vary widely. Toronto has a relatively low tax rate of 0.71529%, while Burlington, with a similar average property price of about $1.16 million, has a higher rate of 0.91815%. Ottawa, known for its affordable cost of living, has a higher tax rate of 1.19564%, leading to $11,956 in taxes for a $1,000 home, compared to Toronto's $7,153. Rates exceed 1.25% in cities like Sudbury, Waterloo, Kitchener, and Guelph. Sudbury's annual taxes for a $1,000 home amount to $12,572. However, this city remains affordable with an average home price of $51,282, meaning few residents face such high assessments. Niagara Falls saw a 4.57% increase in property tax rates, now at 1.552%. London has the second highest rate in Ontario at 1.57313%, followed by Sault Ste. Marie at 1.7891%, which has the highest tax rate despite the lowest property prices. This disparity highlights the complex landscape of property taxes across different regions in Ontario. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found our discussions on currency fluctuations, mortgage costs, housing affordability, and property taxes insightful. Join us next time as we continue to explore the ever-changing landscape of the real estate market in Ontario and beyond. Thank you for tuning in, and have a great day.